Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. It is a brand new year. Actually, why a new year? A new month, a weekend, any week, any day really is a great time to sit down and take stock of your investments and your portfolio. But since this is a new year, it is all about new beginnings. It is perhaps an even better time to just look at what lies ahead over the next 12 odd months and to see whether your mutual fund portfolio is well aligned to your own goals and your risk appetite. And of course, looking at market conditions, what are the kind of funds that might actually do better than the rest? And helping me do all of this week is Kaustubh Belapurkar of Morningstar India. Kaustubh, thank you so much for joining in. First of all, season's greetings. Wish you a very, very happy new year from Team Money, Money, Money.
Same to everyone at CNBC. Surabhi, thanks for having me over.
Okay, so well, we have a task cut out at hand. One is always thinking about whether I have the right funds or not. So I want you to sort of look across the spectrum for us.
Sure.
On the equity side, large cap, mid cap, small cap, even on the fixed income side, and tell us the best funds that we should have.
All right, sure. Okay, so let's get right down to it, right? So it's been an interesting last couple of years, and lay the context. Mid caps are doing really well, small and mid caps, and then 2018 happened where we saw a sharp drop off, and large caps were the ones that protected capital better, and that's something that is expected, a typical market cycle. So I'm not completely concerned, and I think investors should also stay the course. Now, for people who are either already invested or looking to invest further, clearly I think large cap still forms a very dominant part of the core holding of an investor's portfolio. It's the one that while may not give you standoutish returns, but will be reasonably, will be less volatile than some of the smaller or the mid cap funds, and should be the bedrock of your portfolio, really. Okay,
so now as we get down to your funds for 2019, it's a pretty comprehensive list that we are going to cover here. Just give us a brief synopsis that at Morningstar, when you're going about this fund selection process, the top 3 large cap, the top 3 multi cap, what are the most important parameters that you take stock of?
Sure. So there are a bunch of things that our team here looks at. So one is obviously the person and the team that's managing the strategy. So it's not just the fund manager. Obviously, he is the one who's really driving the strategy, but more importantly, also trying to understand the people behind the scenes, the analyst teams, the co-fund managers. So understanding the construct of the team, the experience they have, the more likely the relevant experience they have in terms of managing that kind of a strategy. I think these are some of the things that we assess on the people side. Then we try to understand the investment processes in terms of how does it flow from stock selection to actual portfolio construction, portfolio monitoring. How disciplined are they in terms of sort of sell discipline, buy discipline, things like that. I think that plays a very important role, and also because is it manager centric or is it a more team driven approach? Okay. So every manager brings in his sort of style to a fund, but if there is a larger team driven approach, then we have a fair bit of comfort even the manager leaves. It should be a reasonably steady fund going forward.
Okay, fair enough. So here it is, the Morningstar Top 2019 Mutual Fund Recommendation List, and we are starting it off with the large cap category. So here you have picked out 3 funds that look good to you right now. The HDFC Top 100, the Aditya Birla Sun Life Frontline Equity, as well as the ICICI Prudential Blue Chip. So you've covered the biggest asset managers of the country. Let's find out one by one why you like these funds.
Sure. So I'll just quickly talk about each of these 3. Right? And these are funds that it's not that we've started to like them now, we've liked them for many years. And so if I talk about the HDFC Top 100, so Prashant Jain, who's been managing this for as long as I can remember, great manager, great insights, and this thought process is just so crystal clear. He's backed by an excellent team of managers and analysts, which gives us a lot of conviction on the strategy. Now, if you look at the strategy per se, Prashant is a really high conviction manager, so he will tend to build a slightly more concentrated portfolio. He doesn't necessarily follow the benchmark, so he will take outsizes bets as per his conviction levels. What that also brings to the table is a little bit of maybe, and what we've seen over the last few years, a little additional volatility in the fund, because he's been a little bit of an early cycle investor where he's identified some ideas where were depressed for quite some time. PSU banks, absolutely, and some of them have played out, some of them not, but largely he's stuck by his convictions, and I think SBI is one stock that he's been invested in for a while, but that's his style. So I think it's important for investors to be patient. You will see some volatile blips, but if you're in for the long term, I think this is a great strategy. He brings a very unique sort of blend of growth and value to his portfolio, and we really like that about his style.
Okay. Now the other 2 funds, the Aditya Birla Sun Life Frontline Equity as well as the ICICI Prudential Blue Chip, returns are fairly similar if I look at 3 years or 5 years. So let's take it one at a time. Mahesh Patil, who manages the Aditya Birla Sun Life Frontline Equity.
That's right.
What do you like about this fund?
So again, I think Mahesh's style is slightly different from what I described for Prashant, and that's also very important for investors to think about, that you get managers with different styles in your portfolio. Because if you have managers with very similar styles, then they would probably move in a very similar fashion. So I think Mahesh is more of a benchmark aware kind of manager. So he doesn't really play around too much with sector weights. What he will do is he will take within the benchmark the stocks he can take outsized or underweight positions within that. That's great. And what he also does is builds a reasonably diversified portfolio. So Prashant's got a more concentrated portfolio. Mahesh's style is to build a more diversified portfolio across his top picks. And the other unique thing that he brings to the table that he does is he doesn't mind trading a bit of his conviction ideas. So while he's largely a buy and hold manager, but if he sees there are opportunities that the stock prices really run up, he won't mind taking some money off the table. At the same time, if it's depressed, if he still believes in the fundamentals, he could add some positions.
So he does keep an eye out on the short term as well, along with, of course, retaining a long-term view.
Absolutely.
Okay, so that's Aditya Birla Sun Life. The last one is ICICI Prudential Blue Chip. Again, what are the highlights for this fund? Again,
I think a great team in place. So if you look at the manager, Anish Tawakle, he's very recently started managing this fund. But why we have conviction is obviously Naren, who's at the helm of ICICI for a very long time, brings a lot to the table. But Anish himself, when we've spoken to him and interacted with him trying to understand the strategy, he's got, while he doesn't have fund managing experience, he has extensive research experience. So he brings that to the table. And if you look at this strategy, it's again kind of benchmark aligned. And it's really picking up the best ideas from the analysts on stock, sort of picks and building that into a more diversified portfolio. Largely a growth manager. So, he will really focus on the growth aspects, not worry too much about valuations. So, which should do well over a market cycle again. And like I said, a great team running the show here. So there's a fair bit of conviction that, over market cycles, there's a fund manager who can deliver consistently.
So there you go, a nice kind of a balance, someone like Prashant who's always looking for value, and then you have on the other side, the ICICI team, which is, willing to buy high growth stocks. Well, on that note, we're going to take getting Morningstar's best and brightest ideas for 2019 mutual funds that perhaps you can consider for your portfolio. Kaustubh, so now let's quickly get down to the multi-cap category, which is being very widely sort of advocated these days because there's more flexibility.
That's right.
A fund manager can move across market capitalizations and decide what's best. So important to have good multi-cap funds. Which ones should we look at?
Absolutely. I think you've hit the nail on the head. They have more flexibility, and that's why we've touched upon three funds that we really like. To start with, the Franklin India Equity. I think one, fund that we've really liked for a long time, Anand Radhakrishnan, who's the CIO Equities, runs the strategy. Again, a very, very astute manager, backed by an excellent team of professionals. So that's the first comfort that we derive from the strategy. If you look at the strategy per se, he runs about a 70-30, so 70 large, 30 mid is typically the mandate he would run with. He's largely a growth manager, but he'd also take some contrarian bets, in his portfolio. So unfortunately, 2018 is probably a little bit of a hard time, and some of his contra bets haven't worked for him. But we would expect, because he's a very, very patient manager. We've seen in the past where some of his contra bets haven't worked. He's stuck on to his convictions, or cut losses when the thesis hasn't worked. But his patience really paid off over the long term. So we think this is another strategy which is like an evergreen strategy, should definitely form a part of investor portfolios.
Okay, yeah. So returns down obviously 5% this year, 9% over 3 years, and about 16-17% over a 5-year period. That's this one. You also like the Mirae Asset India Equity Fund as well as the Kotak Standard Multi-Cap.
Right.
Do they have similar investment philosophies, or are they very different type of funds?
So Mirae is actually a more diversified strategy. So Nilesh, another great manager, and if you look at the way he runs the portfolio, he's not really looking to move beyond the benchmark. So in terms of the sector weights, it's really stock selection where his forte comes in. And he's got a very, very keen eye on valuations. So when I say keen eye on valuations, he's looking at good quality businesses. At the same time, he doesn't want to overpay for them. So he focuses on the margin of safety concept, so that when he gets into a stock, he needs to be convinced that he's got enough of a cushion that, if things go downwards, he should be reasonably protected. And that's really paid off for the kind of strategy he's been running. He also runs a more diversified strategy as compared to Anand's strategy. So, kind of reduces the risk, and you would see a much more consistent performance across calendar years for a strategy.
And what's the market cap mix? Because in the first one you mentioned it's 70%, almost 70% large cap.
So it's similar in for Nilesh too.
Okay, and finally the Kotak Standard multi-cap?
Yeah, so Kotak again, which is run by Harsha, he's got an eye on both. So I mean, he does overweight, underweight sectors a bit in terms of both on his growth expectations, and also looks at valuations from historical perspective versus also a relative perspective to the other sectors. So he does bring in that element. So he's also runs a little more aggressive strategy in that sense. But again, I would say largely growth oriented, and I think this is a strategy which has delivered some significantly consistent returns over the years. In fact, it's been a favorite of investors for the last many years. Probably become the largest fund in the industry right now. So.
Absolutely. So that's the fund from the Kotak stable. That's multi-cap funds for you. Now let's come down to the interesting bit, mid-caps and small caps. And lots of people want to take the risk, want to believe that this is going to be again a dream year for mid-caps and small caps. Starting with mid-caps, the funds that you'll go for.
Okay. So firstly, I would advise that you need to bite that bullet a little bit, that be ready for volatility in mid and small caps, and have a very, very stable 7 to 10 year investment horizon. That is the first thing I would advise investors. When I look at some of the funds, and we've picked two slightly different funds. So one is from the Franklin stable again, the Prima fund, with Janki Raman, who's their mid and small cap specialist who runs this fund. So if you look at the strategy, one is, given that mid and small, there's not so much research, you need to really focus internal efforts into getting out the best ideas on these counters. So Franklin's built an excellent team of analysts, with wide experience, who can go and identify these ideas, from the small and mid cap space. The other thing which Janki does is knowing the fact that, you need to get your stock picks right. He focuses a lot on corporate governance standards and the quality of the balance sheet and the quality of the management, really, because you don't want to be stuck with a stock where promoters run away or things like that. So I think there's an immense amount of focus. So he's ready to trade off a little bit of gains if he doesn't believe in the quality of the management. So I think there's a lot of focus at Franklin. Not that others don't do it, but I think there's probably an extra focus that Franklin brings in on that. So the other thing he also does is builds a fairly diversified portfolio just to reduce risk. So all of these factors, give us a lot of comfort in terms of, the manager and the process that he's running, that this will be a very, very good strategy even going forward. Yeah,
I mean, you have to be prudent when it comes to this, this part of the investing universe, I suppose. The DSP mid-cap is what you like, and that also brings me to one of the best-known mid-cap and small-cap managers, Vineet Samre, and he has really been a rank outperformer over the last couple of years. Do you expect that consistency to keep playing out? And that also brings me to the small cap side of things, because you do like Vineet's small cap fund as well.
That's right. So the interesting thing that you brought about is consistency. So in fact, people have been questioning, because his small cap fund has seen a bit of a hit in 2018, much more than the peers. But I would say that, worry not. And like you rightly said, I think Vineet has been one of those flagship small and mid cap managers. He's really sunk his teeth over the last 8-10 years into managing some of these strategies. The mid cap he's taken over more recently, 2015. But the micro cap, which is now known as the small cap, he's been managing for a very long time.
And it's open for subscription again, because the fund was shut for a very long time.
The mid cap's still open. The small cap is open through SIPs. So I'll talk about both funds together. I'll just make it easier. Again, Vineet. Very, very research-intensive process in terms of, again, identifying those quality companies. You don't want to get that wrong. So clearly, there's a lot of focus on that. He spends a lot of time himself meeting the management, because that's actually doing channel checks and things like that. You need to do that additional level of due diligence that's required. So I think they spend a lot of time in identifying the right set of ideas. Pretty patient managers. So it's a buy and hold strategy, as it should be in a small and mid cap side. Also, what he started doing is taking some value contrarian bets as a part of his portfolio, just to add a little bit of a variation in the portfolio, where you'll see some beaten down themes or sectors or stock ideas where he fundamentally still believes are strong, but extraneous factors have pulled them down. Is where he'll probably come in, might bear the pain for some time, but it should pay off over the long term. So I think two really good strategies, both from the mid and small cap side, and we would definitely look at recommending. The other small cap fund we haven't spoken about is from the HDFC stable. So another great manager, Chirag Setalwad, who's been managing the mid cap strategy since inception. Small cap is a fund that they've reconstituted over the last couple of years. The last 2 years to be specific, it's become a pure small cap fund. But again, just HDFC's bandwidth and ability to identify those ideas. Because when we talk about small cap stocks, we're talking about beyond the 250th market capitalization. So if you're really going down the capitalization curve, you need to have enough conviction. And he looks at companies that have high ROEs, good free cash flows. I mean, these are some of the metrics that he would put into place when he's identifying. Obviously, quality of management, all of that is paramount. And then he would build a fairly diversified portfolio again. And we've seen 2018 where small and mid caps have really fallen off the charts. This fund's actually fallen a lot lesser than the peers. And I think that's where that quality criteria really paid off for him.
So let me ask you this: over at least a 3 to 5 year period, if you're investing in a mid-cap fund and a small-cap fund, what is the realistic return that you should and can perhaps expect, because you're taking on that kind of risk?
Yeah, so I would probably want to extrapolate that time period. I would probably say
10 years.
10 years. I think a 15%. As we've witnessed, should be doable. Again, caveats that markets are unpredictable, but I think that's a reasonable amount of return to expect for the risk that you'll be taking on. Large caps would probably trend a little lower, but 15, 17% should be something on a CAGR basis, should be doable. The other good part is that we've been adding a lot of new listings on the small and mid cap side, right? So exciting new companies with great growth prospects from sunrise industries coming in. Managers can identify them, and you can really ride that growth wave.
Well, as long as they work, some of these IPOs are flatter to receive in the recent past. But anyway, to round up the equity side of funds for 2019, tax saving funds. And it's interesting because here an Axis name finally popped up. You like the Axis long-term equity. Interestingly, Axis, I think, has been like the mutual fund house of 2018, because a lot of their funds, the large cap, the mid cap, they did exceedingly well last year.
Yes, that's right. Absolutely. So I think they bore the pain of their stock picks in 2017, but that patience paid off for them in 2018, and all credit to Janesh and his team. So Janesh, who's the CIO equities, who manages the strategy. If you look at this, he's running it a more concentrated approach, his high conviction ideas, and at the same time, he's an out and out growth manager. He does not really worry about valuations as long as growth, pays off for those valuations. So that's really the portfolio that he would like to build. And that's really that segment of the market that has done well in 2018, which didn't do so well in 2017, like I mentioned, but over a market cycle, this is a fund that we really like. And we think of this as not just as a tax saving instrument, but you can just get into it as a multi-cap strategy too. I mean, that's one way of looking at it. While you have a 3-year lock-in, it kind of enforces some discipline any which ways.
Okay, so that's one fund. And the other that you like, I think that's such an old fund, the Franklin India Tax Shield. I think everybody at some point in time or the other in their lives have had some money in this fund.
That's right.
But at least returns, I mean, last 1 year to 3 years have been kind of underperforming other funds.
Yes, so there has been a little bit of and one element has obviously been because there's a slightly larger large cap exposure in this fund, and some of their contra bets haven't worked, for the fund house as a whole, like I mentioned. So this fund it's a recent manager who's taken over the last couple of years, Lakshmikant Reddy. Anand used to manage this fund earlier, but really the core of the fund remains the same. So he's more of a GARP, so he does look at valuations. Like I said, Janesh doesn't really care too much about valuations. There's a more clearer focus on valuations here. So, growth at a reasonable price is his style. A more diversified portfolio, but he doesn't really care about the benchmark again here. So it's that typical Franklin style in terms of, the benchmark agnostic structure. But, I think over a market cycle, they should come back up the curve.
Okay, that's a lot of equity funds, and for the benefit of our viewers, let me quickly round this up. So large cap funds, the Morningstar View for 2019, the HDFC Top 100, the Aditya Birla Sun Life Frontline Equity, the ICICI Prudential Blue Chip Fund. Coming to the multi-cap category, there's Franklin India Equity, Mirae Asset India Equity, and the Kotak Standard Multi-Cap. Let's come down to the higher risk areas, mid-cap funds. Here there are two choices that Kaustubh has picked out, the Franklin Prima Fund and the DSP Mid-Cap. Down to small caps then, again, DSP, the small cap fund this time around is Kaustubh's pick, along with the HDFC small cap. And the tax savers, if you're looking at ELSS funds for 2019, then the Axis long-term equity and the Franklin India Tax Shield Fund. So that's a lot of money. And this week we are in conversation with Kaustubh Belapurkar of Morningstar, getting mutual fund ideas for 2019. We've covered the entire equity universe. It's time to talk about fixed income now. And this is a, I think, subject that can go on for an hour in itself, Kaustubh. But broadly speaking, is this going to be a year of duration funds? Should you try and look at playing interest rates, because people say interest rates will fall this year? Should you stick to accrual and basically look at high yielding funds?
So, the street themselves have been a little bit of a quandary in terms of, what rate action RBI is going to be doing. So it's a little bit of a hit and miss there. And if when you speak to the managers, I think what now the expectations really become is that there could be one rate cut, but there's already a pricing in of that in the bond yields. So most of them, while they did make some opportunistic sort of tactical calls on the duration side, not very aggressively, because we've been sitting on low duration for a while, they did take some opportunistic calls in October, November, but have started again, probably still lying a little low on the duration curve. And I think the general expectation is that they wouldn't really go very aggressive on duration till they see clear signs of the interest rate cycle turning around, that you start getting into a multiple rate cut sort of cycle. Right now, there's a little bit of a question mark on that. So given that focus, I think for investors, clearly the focus should be on looking more on the lower duration side.
Okay.
And clearly, if you have and then you match your investment time horizon with the kind of funds you would want to take. So, for instance, if you have just about a 1 year investment horizon, then you should look at something from the ultra short bond or the low duration side.
Okay.
And we've spoken about two funds here. One's the Kotak Savings Fund,
all right,
which is clearly on that ultra short bond side, which maintains its duration between 3 to 6 months.
Okay.
Essentially, very, very low interest rate risk. So it just keeps earning the carry on the portfolio. And what it's also done, the manager Deepak Accrual also maintains about 15 to 20% in SubTriple Aim. When I say SubTriple A bonds, he's looking at typically A's and A pluses. So not really going down the credit ladder, but just to, given the yield curve, just to build a little bit of additional kicker in the yields for the portfolio.
So what should I expect if I'm investing in this fund for a year or so? What is a reasonable return expectation?
I would say about 7.5 should be a reasonable sort of kicker that comes in there.
Okay, fair enough. Any other ideas, and how do you find the whole accrual category? Also, a lot of investors who come into fixed income funds do so because the tax advantages start kicking in after 3 years. So for this bucket of investors, what would you advise?
So let me maybe just quickly talk about the other fund that we have, which is Reliance Low Duration for less than a year. So again, very similar strategy to Kotak. Anju, who manages the strategy, again, but it's only in a 6 to 12 month bucket, so slightly higher element of interest rate risk or duration. But again, the portfolio constructs pretty similar. 85% in AAAs and the remaining in AA pluses. So that's fairly straightforward. To answer your question about what do you do for a 3-year perspective, right? And we've kind of given funds from each bucket. So you have an accrual strategy. One, the HDFC Corporate Bond Fund, which is a pure AAA sort of corporate bond portfolio. So for your very, very risk-averse investors who just want to earn a safe carry of a AAA bond, this is a good strategy to come in. Typically runs a duration between 1 to 3 years. And like I said, AAA bonds with the majority of the portfolio, and a very, very low expense ratio, which is a very important aspect given that margins are wafer thin, returns are anyways.
What is the expense ratio?
So this is in the range of about 30-35 basis points.
Oh wow, that's completely amazing. That's even better than some of the index funds, etc. that we have out there. And again, what should be the return expectation from something like this?
So again, it'll be in the similar bucket, maybe 25-30 basis points higher than what I mentioned, because you're taking a little bit more of duration risk. The yields are, in excess of 8.5%. So if you just look at the net yield, would still be in excess of 8% right now.
Okay, so that's one fund. Anything else in the 3-year bucket?
Yes. So then what we've done is, this was for the most conservative investor.
Sure.
Then there's something in between, which is the Aditya Birla Short-Term Opportunities Fund, which does a mix of a portfolio. So it's got about 50-55% in pure AAA sort of bonds. And the remaining, a majority of going to AAs, and about 10-15% in single A rated instruments. So what it does, it gives you a yield kicker.
Because you're taking higher credit risk.
Higher credit risk. So the credit risk has gone up. So that's what investors need to understand.
And how much should then the return be higher by, because you are taking more risk?
So you would typically expect maybe a 50 basis points yield kicker on this at least, given where the current spreads lie at, and that's what it'll be. So that's really on the short-term opportunities fund. Again, Manish and his team that have been running it excellent, both on duration and credit risk. So, we have an immense amount of comfort that even though they're taking on some credit risk, they know how to manage these kind of strategies really well.
And on your list, I also see the Franklin India Short-Term Fund.
Correct.
Now, where does this fit in?
Yes. So now this fund is an out-and-out sort of credit exposure fund. So if you look at the way Santosh and Kunal, who are the managers of this fund, they're hunting for high-yielding papers. But really, that's where they've built their expertise. Franklin's been one of the pioneers in getting into, investing into the AA, single A sort of spaces. And they've been doing a lot of work around getting new issuers on tap, structuring investments so that, there's enough amount of collateral or, comfort that even if you're getting into a slightly lower rated paper, you're getting a yield that is, which pays off for the risk that you're taking. And that's why this, currently, if I look at the yield, it's in excess of 11% on the portfolio.
Wow, this fund is giving you 11%.
Yes. So obviously, because more than 85% of the portfolio is in double A's and single A's. So then that's where the yield kicker really comes in for the strategy.
So I mean, take your choice, take your pick, and that's why when you're getting into fixed income funds, it is so important to know your time duration of investment and your own risk profile, because 11%, 3 years with the tax advantage sounds like a great deal, but then you should be willing to stomach the volatility that might come along with it.
So I might just correct you here. So it's the gross yield. I mean,
so
just to be on the same page.
All right, that's